Okay, today we want to talk about the CAPM. Now look at the picture that I've drawn here. RKT is Rock-Ten. Rock-Ten is a Georgia-based company that makes cardboard products. If you've had Chinese takeout food, the box that the food came in was probably made by Rock-Ten. MKT is the market. So I want to know, is there a relationship between the returns on Rock-Ten and the returns on the market? So I've applied on the x-axis returns on the market, the y-axis the returns on Rock-Ten. So let's pick a point. This point right here. The market was up between 5 and 10%, maybe 7%. Rock-Ten was up 0. Let's pick this point right here. Rock-Ten was up almost 40%. The market was up about 12% or so. So that's all I've done. I've taken the last 60 data points. I think it's 60. And I've drawn the blue, put the blue dots in there. I would like to know, is there a relationship? So in other words, if you tell me what the market did, well, I'll be able to figure out what Rock-Ten did. Just looking at the blue dots, the answer is, well, there's a pattern, but it's not a perfect pattern. So I draw this straight line, and this straight line is going to be my best guess, and that's what the CAPM is going to tell me. So let's move this out and let me show you something real quick. So the CAPM says the return on Rock-Ten is equal to the risk-free rate plus a risk premium. Right? And this is what everybody can agree on. If I'm going to buy a risky stock, I need a greater return than we get if I bought a U.S. Treasury security that has no default risk. So what is that risk premium? Well, the CAPM is going to say the risk premium is equal to the risk-free rate. The risk premium is equal to beta for Rock-Ten times the return on the market minus the risk-free rate. Now, when I say the return for Rock-Ten and the return on the market, I mean the expected return. I'm just writing it as RM, expected return. Technically, should be writing it like that, but just to make it simpler, remember these are expected returns. This term in brackets is the market risk premium. So you tell me how much extra return I should get for holding a stock, and by a stock I mean the market. You tell me what beta is. Beta is a relationship between the market and the individual stock. Technically, beta for Rock-Ten is equal to the covariance of Rock-Ten and the market divided by the variance of the market. But importantly, all I want you to think of is the beta gives a relationship between the individual stock and the market. And this term, like I said, is the market risk premium. That term right there is the return on the market. So theoretically, what I can do is this. I can draw a nice graph. It looks like this, where this is the market return. This is the return, in this case, on Rock-Ten, my individual stock. And I know if the market does something, Rock-Ten should do something in a reliable fashion, and it should look something like that. So each point here, the market goes up, Rock-Ten goes up. The market goes up, Rock-Ten goes up. The market goes down, Rock-Ten goes down. And every return pair for the market and Rock-Ten lies on that perfectly straight line. If that's true, then the CAPM works exactly. But once again, look back to what we have in reality. So that's the theory. Everything's on a perfectly straight line, but all the blue dots here are not on a perfectly straight line. So this tells me that the CAPM doesn't work perfectly and exactly. Next thing. Okay, so let me put some actual numbers on this. I want to figure out how to draw this line, and obviously just eyeball it is not going to work. So what we do is we run a regression, and if you're not familiar with the regression, I can give you some background on that later. But basically what the regression is going to do is tell me the slope of the line. The slope of the line is equal to beta, which is 1.19. It's also going to tell me this intercept right here, that's alpha, which is equal to 0.02. So I run a regression in Excel, and Excel tells me, get rid of this number, Excel tells me that the intercept is 0.02 and the slope of the line is 1.19. What the CAPM tells me is this: the return on Rock 10 should be equal to the risk-free rate plus beta 1.19 times the market risk premium. So I'm going to say capital RM is equal to little rm minus rf. I'm going to say capital R subscript Rock 10 is equal to this. So if I subtract the risk-free rate from both sides, that should be beta. So what I have, this is kind of the bottom line here. The return on Rock 10, and by capital R I mean the return above the risk-free rate, should be equal to the beta of Rock 10 times the market risk premium. Okay, so that should always be true. So we'll always have the blue dots be exactly on the line. The blue dots are not exactly on the line, which means this doesn't predict exactly what's going to happen. So we have another number called the R squared. The R squared in this regression was 0.29. This is important. This means that 29% of the variation of Rock 10 was explained by the market. So I have this model that tells me this is how I price a stock. This is how I determine what return on Rock 10 I should get. The risk-free rate, the market risk premium times the beta of Rock 10. This is the actual data, and I can tell you from the Excel output that only 29% of the variation of returns of Rock 10 is explained by the market. That leaves 71% unexplained, which tells you immediately there's a problem with the market, with the CAPM. The model doesn't explain everything. The model also tells us that the beta, the slope of this line, is 1.19. Theoretically, the return should be 1.19 times the return on the market. But the intercept here is 0.02, so you got 2% above what you were supposed to get. Alright, so there are a couple of issues that I want to talk about for this in reality. So the issues are in estimating beta. So we know that the return for Rock 10 should equal alpha plus beta, and this is the alpha for Rock 10, the beta for Rock 10 times the market risk premium. Alpha should be equal 0, but in this case it's not. In this case, alpha is actually equal to something above 0. Beta How do I find beta? There are three issues here. Issue 1 is what I'll call market proxy. Alright, this is not in your text, or at least it's not explained well in the text, but these are the important takeaways for real life. When I say the market, theoretically, that's every asset ever traded anywhere. But I can't get the price of every asset that's traded everywhere. So I have to choose a proxy for that. I can choose, typically people would choose the S&P 500. But if I choose S&P 500, that's only 500 stocks. I could choose the Wilshire 5000. I could choose any number of different indices, the Dow Jones, the NASDAQ, choose whatever different index I could think of. In this particular case, I have the valuated, so my market in this example is the valuated return, on every stock on the New York Stock Exchange, the Amex, and the NASDAQ. Is that the right market index? I'm not really sure. If you ran the same numbers but used the S&P 500, you would get something different. I can't tell you which one is right. Number 2, time horizon. I chose the last 5 years worth of data. For Rock 10, is that accurate? Should I have used 1 year, 2 years, 5 years, 10 years, 20 years? The answer there is I'm not really sure. Rock 10 changes over time, so maybe they're not the same company they were 10 years ago, so maybe I just want to use 5 years worth of data. Let me give you what I think of the classic example of this. Microsoft. Microsoft went public, I don't remember the exact time, somewhere around 1987. So I could run a regression. I could get all the data from 1987 to 2012 for Microsoft, draw all the little blue dots, and see the relationship between Microsoft and the market through that time period. My question is that accurate? So is Microsoft the same company in 1987 that they are in 2012? The answer is no. Very simplistically, I could say they're a very risky company in 1987 because you didn't know what they were going to be, and now they're a mature, well-known company. You know kind of exactly who they are today. So I don't know the time horizon. 3, time interval. In this case, I chose monthly data. Sometimes people choose weekly or daily. By the way, the general standard approach for market proxy, S&P 500, time horizon 5 year, time interval monthly. Some people use 2 year and weekly. So when you're looking at betas that are already calculated, it's important to know that the beta is an estimate. There is no one knows what the true beta is. It is an estimate. It is an estimate that varies depending on choice of market proxy, time horizon, time interval. All those things are extremely important to know. Alright, so when we use this in practice, what do we actually do? What I want to do is the following. I want to be able to determine the return on an individual stock. I determine that by knowing the risk-free rate plus the beta for that stock times the market risk premium. So in the classroom, this is easy. There are 1, 2, 3, 4 different variables, and I gotta give you 3 of the 4, and you solve for the other one. So I can either tell you the return on the market is, get the terminology right, this is the return on the market, or I can tell you the market risk premium is, that's the market risk premium. This then tells me what the return on my stock should be. The only problem is I don't know what the risk-free rate should be. Risk-free rate I observe in the market, but should that be the 30-day T-bill, the 90-day T-bill, the 10-year Treasury? You know, I have 30 years worth of risk-free assets. That's what we just did, bootstrapping the spot rate curve. Which one of these should I use? That's unclear. 2 is beta. Beta is just an estimate, right? So it's an estimate based on the 3 things we talked about before. I'm unsure what I should use for beta. 3, market risk premium. Market risk premium, what should that be? I can estimate it based on historical data. I can estimate it based on survey data. I can estimate it based on an implied market risk premium. All I want you to take away is there are 3 different ways to do these estimates, and all 3 are flawed. So this is a very soft number. And the R squared in our particular case was 29%, and that's not unusually low. So this model, this CAPM model, though theoretically is great, is deeply flawed by knowing what estimates to put in for the different variables here, and it doesn't explain everything that needs to be explained. Let me draw you one graph here. Last little graph, and change colors. What we have here is the security market line. This is beta, this is return. So it says that any stock, you tell me the beta for the stock, then I should be able to tell you the return. So every stock should lie on this line. The reason for this is as follows. When we did a measure of risk before, you said the variance of ROC 10, that was equal to the total risk of ROC 10. But I'm telling you the variance of ROC 10 consists of 2 different things. The beta for ROC 10 squared times the variance of the market plus this error term for ROC 10. So this is called the market risk. This is called the firm-specific or idiosyncratic risk. As a well-diversified investor, I don't only own ROC 10, I own hundreds of stocks, or at least 30 or 40 stocks. And so what happens is the idiosyncratic risk cancels out, and the only thing that's left is the market risk. Therefore, all I need to price a stock is the beta, and the beta is a measure of my market risk. If I see a stock that has an expected return, so I do my own security analysis, and I determine the expected return for stock A, which has a beta, that's the beta for A, that's the return for A. Over here, stock B, this is the beta for B, this is the return for B. So if I look at stock A, its return is higher than it should be, I want to buy it. Stock B, the return is lower than it should be, I want to short it. The CAPM says everything lies on this line, and if you can find something that's off this line, that's a mistake in the market. If it's above, buy it, below, short it, and you'll make money. Okay. Last thing, well, 2 more things. One is some guys improved this model. So Fama and French came along, and they said the return on an individual stock is not only the risk-free rate plus the beta of the stock times the market risk premium, there are two other factors. This should take care of everything, but for some reason, if I take firms, this is small mass big, so there's a size effect that beta doesn't capture. So if I get the size premium, that's going to matter. There's also high minus low book value, that's going to matter as well. So Fama and French came up with two more risk proxies. The market matters, the size matters in addition to what's reflected in the market. The book value of the assets, high book value minus low book value, matters as well. Then two other guys came along and they found a momentum effect and a liquidity effect. And this serves to increase the R squared. So the whole point of this is the CAPM is basically this portion. Fama and French came along and they added these two terms to make the model better and make R squared go up. And then two other guys separately added these two. So currently the state of the art, the best model we have is this 5-factor model, and getting all these different risk proxies should tell you the return on the individual stock. The math of this is easy. I give you the premiums and the coefficients, you just fill it in. Alright, last thing, talk about market efficiency. So market efficiency. And this simply says that the price of a stock fully reflects information about that stock. So the information portion is the key. We have three different forms of market efficiency. The first is weak form. Weak form market efficiency says stocks fully reflect all trading data. You hear the term technical analysis, or the technicals of a stock. If the market is efficient, knowing the past patterns in price and volume of the stock will not help you predict future returns. So let me say that again. If the market is weak form efficient, that means looking at past patterns in price and volume of the stock will not help you predict future returns. So you cannot have a rule, and they're called filter rules. If the market is weak form efficient, filter rules don't work. Filter rules are, if the stock does X, then you do Y. So if the stock goes up 10%, then buy. If the stock goes down 10%, then buy. And, you know, there's no way you can look at a pattern in the past data for prices and volume and come up with a rule that makes you money. That's if the market is weak form efficient. The next is semi-strong. Semi-strong is all public data. So I can't make a profit just by knowing public data. Public data would include anything in weak form data. So all past trading data is publicly available. But not only do I have the past trading data, I also know, you know, the financials that have been released. I know information. Well, think about GM, for example. I know their past trading data for GM. I know their financial statements for GM. I know gas prices. I know the performance of their cars. I know what the economy is like. I know all this information, and I still can't make any money off of it. Can't make money off publicly available data. 3 is a strong form, market efficiency, and that's all data, public and private. If the market is strong form efficient, I can't make money even if I'm Bill Gates trading Microsoft. Alright, so the question is, which one of these are true and which one is not? I'm going to say the market is not strong form efficient. Most people will agree with that. It's not strong form efficient, which means if I'm an insider, I can make money. So insiders make money. Think of the movie Wall Street, the original one. Michael Douglas told Charlie Sheen, I want information, buddy boy. Information. I want to know stuff that other people don't know. So if I know something about Microsoft or GM or any company that you don't, I can make money trading that. The market almost certainly is weak form efficient. There's some evidence against it, but I will say most people will tell you, most academics will tell you that it is weak form efficient because I can't look at past trading data and make a profit. This is where the debate is. Is it semi-strong form efficient? So with publicly available data, can I make a profit? I would argue that you can't. There are some anomalies listed in your book, and if you're interested, read through those. But this is basically what I want you to know. So the bottom line to this is that in order to make a profit, so to make money trading stocks, you need to have either 1, better information than anyone else has, or 2, better skill interpreting that information. So if you look at Apple stock and you say, I think Apple stock is a good buy, what is it that you know about Apple that no one else knows? Or what is it that you're able to piece together and figure out from the available information that no one else can? Here's something to think about. There are a lot of smart people following Apple stock, right? So how is it that you know something they don't know, or how is it that you have more skill than all these smart guys following Apple stock? Last example. What about unknown stock? So there's some unknown stock, ABC Corporation. Very few people have ever heard of it. Very few people follow it. It's not a big stock. It's easier to make money here because it's easier to get information about this stock that other people don't have, or maybe it's available, they just don't follow the stock, they don't pay attention, and it's easier to have more skill because the smaller, less skilled people perhaps are following that stock. Okay, so that's all I want you to know about the CAPM and market efficiency chapters, and it also covers the final French chapter.